See, seller financing can be a powerful tool or a long term headache. The difference is in the deal itself. It's whether the seller understands the risk before signing. On this channel, I break down real estate and business without the hype. Seller financing, it means you as the seller becomes the lender. Seller financing happens when the homeowner agrees to accept payments over a period of time instead of getting all their payments upfront. It's legit, it's common, and in the right situation, it can work very well. But once you agree to it, you're no longer just selling a house. You've now extended credit. You've moved from being a seller to being a lender. Now, as a lender, can you carry the risk? That's where the puzzle comes in. Now, it may backfire. When does it backfire? Bank verifies income, don't forget. Assets, credit history, reserves, and many sellers don't. If the buyer couldn't qualify with a bank, you have to ask yourself the question, why? Some sellers agree to informal term, no strong promissory note, no recorded security deed or mortgage, no clear default clause. That's how problems begin. Over the long haul, a 20, 30 years payment stream seems stable until changes happen in your life. What if you need liquidity? What if the market shift? What if you want to invest? Have you given those a thought? Sometimes sellers agree because they feel pressured or they feel they will lose the buyer. Speed should never replace clarity. When does seller financing actually make sense? This is when you have authority and you always want to have authority. Now, let's be fair. Seller financing can absolutely work. It makes sense, for example, when you as a seller don't need immediate cash. When the property is difficult to finance traditionally, the buyer has strong financial history. The interest rate compensates the sellers properly. There is a balloon payment within a reasonable time frame. Legal protections and all is drafted or are drafted professionally. You see, when structured correctly, seller financing can create income, tax advantage, and strong returns. Structure is everything. A properly structured seller financing deal should include one, a promissory note, two, security deed or mortgage recorded, clear amortization schedule, define default remedies, insurance requirements, escrow for taxes if appropriate. This isn't paperwork to skip. This is protection. Seller financing is not the problem. Poor structure is. When sellers don't understand the legal, financial, and time and the risk involved, that's when it backfires. Clarity protects equity any day, anytime. If you are considering seller financing, don't rush the decision. Make sure the deal is structured to protect you, not just the buyer. Subscribe for real estate clarity without the hype. My name is Mike Day. I'm the king of the suburbs, Atlanta real estate and business market.